Hey everyone, welcome back to Corporate Decoder. We're diving into Vivos Therapeutics' latest filing today, and let's just say this one's got a bit of a payday to plan flavor. You know, like getting some cash now with big promises later. Before we start, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these filings even further. So, Vivos Therapeutics Inc. has just filed what is called a Form 8. Think of this as a company's way of telling the public about pretty big important things that just happened, things that aren't already covered in their regular financial reports. And the big news here revolves around a recent agreement, a way to get some much needed cash. Basically, on the 15th of January 2026, Vivos Therapeutics, which we'll just call the company from now on, signed a deal with a group called VCO Investors 3 LLC, or VCO for short. They got something called an unsecured convertible promissory note. Now, that sounds complicated, but let's break it down. This note is like an IOU, a promise to pay back money. Up to a whopping $5.5 million could be loaned to the company by V Company. And here is the kicker. It is unsecured, meaning VCO doesn't have any specific company assets to grab if Vivos can't pay it back. It is all based on trust and the promise of future value. It is also worth noting that VCO is connected to New Seneca Partners Incorporated, which is already involved with the company as an advisor and private equity investor. So this isn't a completely new relationship, it is more of an expansion. The main reason for this note is to get some financial help for a planned big event, an equity financing. This means the company plans to sell more of its own stock to raise money, and they're hoping to get up to $5.5 million from that. This loan from VCO is essentially a bridge, a way to keep things going until that bigger fundraising round happens. They've set an ambitious deadline for this future fundraising, aiming to wrap it up by the 16th of February 2026. That is their outside date, the final date to get this done. And they didn't wait around. As soon as the deal was signed on the 15th of January, VCO already put $900,000 into the company's bank account. That is immediate cash flow. One important detail is the financing fee. VCO is getting a 10% discount upfront on the total amount they might lend. So if the company ends up borrowing the full $5.5 million, that 10% is essentially a fee for VCO, meaning the company effectively gets a little less than the full amount in cash for the maximum principal stated. It is a way to compensate VCO for taking on this risk. Now, here is an interesting part about the interest. The note itself doesn't charge any interest under normal circumstances. It is interest-free. However, if things go wrong, like if the company can't pay back the money when asked, or if they violate other terms of the agreement, or even if they enter bankruptcy, then things change dramatically. In the event of what they call an event of default, interest suddenly jumps to a hefty 15% per year. That is a big jump and a serious penalty for not meeting obligations. The other major aspect of this note is its convertibility. If the company successfully completes that upcoming equity financing before the deadline, the entire amount borrowed under this note will automatically convert into the same stocks or securities being sold in that new financing. This conversion happens automatically, no extra paperwork needed on either side. If they don't manage to raise money through the equity financing by the 16th of February deadline, the company has the option to pay back whatever they borrowed, principal, and any accrued interest if a default occurred, without any penalty. This gives them an exit strategy if the future financing falls through. And to make things official, they filed the actual agreement, the convertible promissory note, as an exhibit. This is where all the fine print is located. Now, let's talk about what this means from a broader perspective. This filing tells a common story in the world of public companies, especially those that might be considered smaller or are in growth stages. They need cash to operate and to fund future projects like that planned equity financing. When a company needs money and can't immediately get a traditional bank loan, they often turn to options like this. Convertible notes are popular because they offer a company immediate liquidity or cash, while deferring the dilution of existing shareholders until a future financing event for the investor, VCO in this case. It is a way to get into the company potentially at a discount and with a clear path to converting their debt into equity. The ticker symbol for Vivos Therapeutics is VIVOS. This filing is crucial for investors to understand the company's short-term financial strategy and potential future equity structure. The fact that this is an unsecured note highlights the reliance on the company's future prospects and the strategic importance of the upcoming equity financing. It is also interesting to note that Vivos Therapeutics has identified itself as an emerging growth company. This means they can take advantage of certain accommodations in financial reporting, which is common for newer or smaller public companies. They also elected not to use the extended transition period for new accounting standards, suggesting they are aiming to keep their financial reporting current. So, what is the takeaway here? Vivos Therapeutics is actively seeking to bolster its financial position. They've secured an initial injection of cash and have a framework to potentially raise much more through an equity offering. The success of this entire strategy hinges on their ability to execute that subsequent financing. If they can do that, this note effectively becomes a pre-funding mechanism for that larger capital raise. However, the risks are clear. If the equity financing doesn't happen, the company still owes the money and the default interest rate is quite high. This puts pressure on management to deliver on their fundraising plans. For investors watching VVOs, this note is a key factor to monitor. It signals the company's immediate funding needs and the potential for future dilution as this debt converts into equity. In my opinion, Vivos is playing a common game of bridging capital needs with the promise of future growth. The strategy makes sense if they have a strong conviction in their ability to close the subsequent financing. The 10% discount and the potential for 15% default interest are significant costs that underscore the urgency of their situation. The company is showing resourcefulness in securing funds. But the ultimate success will be in the execution of their broader financing strategy and the underlying business performance that will attract equity investors. It is a carefully structured dance between immediate needs and future potential. Alright, that is our breakdown of Vivos Therapeutics' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.